Well, welcome to the next quarterly market and economic update. It was quite a busy Q1 2022, but my name is Mike Horwath. I'm the Chief Investment Officer here at Diversified. So as we do every quarter, we like to recap what happened and what we're seeing and where we think we're going and how we're positioning in that environment. So one thing we're changing is instead of doing a video and releasing a recorded video, we want to do a live webinar this time instead of doing a recorded video. So we're doing a live webinar now on a quarterly basis along with a newsletter. So the newsletter is going to be quite wordy. As you can see, I write a little wordy, but I wanted to give a very detailed breakdown of what we're seeing in markets, why things are happening the way that they are, what it all means, how we're positioning portfolios. So you'll see that write-up coming out here in the next several business days or week or so. But once again, my name is Mike Horwath, the Chief Investment Officer here at Diversified. We're just here to catch up on a quarterly and economic market update. So let's just jump right on in. Q1, it was busy. Some of it was more domestically related. Some of it was the unfortunate situation in Ukraine. But let's kind of take a step back. And most people will assume that the conflict in Ukraine was the primary driver of market volatility. And it's important to remember this all started before February 24th, which is the kind of the official date that Russia invaded Ukraine. A lot of the volatility occurred before that. Why? It was really driven around the Fed, and it all kind of stems back to inflation. If you look back to November, all right, so starting in November 2021, expectations started to change for what the Fed would have to do with interest rates in 2022. What we started to see was that they became a little bit more concerned about the persistent nature of higher inflation. And in order to fight that, they were going to raise interest rates. Expectations at the time were 3-4 times here in 2022, more methodical. Well, as inflation continued to remain high, and then as we continue to move through Q1, we have this energy shock and commodity shock from the conflict in Ukraine, where now all of a sudden we're staring at 6 or 7 interest rate hikes here in 2022. So the Fed's changing narrative and what the expectations have changed to were the primary reasons for all this volatility, right? The volatility really stemmed from markets repricing themselves in that type of environment. Right? If you look at the sector level, energy was the only positive sector in Q1 2022. So the conflict in Ukraine, though, is just putting pressure on prices, right? It's putting pressure on energy, on precious metals. So nickel is an example, on agricultural products, because a lot of different types of agricultural products like wheat come out of both of those countries, right? Those are the primary exports of Russia and Ukraine. All of a sudden now, all of that has been affected. The Fed's been very transparent, though, that they do intend to raise rates, that they are shifting their policy. They are willing to sacrifice growth, GDP growth, for the sake of taming prices, right? So taming inflation and getting it back down around that 2-ish% annualized figure that they really target. We think part of the reason that they're willing to be more transparent about their aggressive stance is that the consumer and economic conditions are strong. You'll see it shortly. We'll talk about it a little bit more extensively, but the consumer is very healthy today. And that doesn't mean that their stance changing on monetary policy, so raising interest rates, won't hamper demand. It won't hamper consumers, but consumers are in a good position to be able to withstand the change in their monetary policy stance. Things have been very easy for a decade plus now, with very low interest rates, right? And monetary policy has been very loose, right? They've been increasing the money supply rather than restricting it. Things are going to have to change, right? That it will have to be adjusted. But economic conditions are strong. We're going to continue to talk about that here throughout this webinar. And corporate earnings, right? It all kind of stems together. GDP growth, consumer spending, consumer health, and then it all kind of ties back together with corporate earnings, which have been rather strong over the last several years. We expect them to continue to be strong. We do expect some choppiness within markets. We do expect that Q1 may produce okay earnings, right? So it's still strong, but not to the level that we expect to see later on in the year. So that would be the general economic highlights. I would kind of point to the graph on the screen of the U.S. Treasury yield curve. What's important is the dark blue line is about a year ago, right? So it is back in March 2021, and all of a sudden you see from when the Russian invasion started on February 24th, right? So this is from February 25th, that light blue line, and then the purple line is as of March 25th of this year. You can see that expectations for bonds, the yields have risen, the prices have fallen, markets are pricing in interest rate increases 6, 7 this year, another probably 3 or 4 in 2023. That's already priced into markets. Important to remember that. So let's talk about the asset class returns in Q1. So global stocks represented by the MSCI All Country World Index down about 5% in the quarter. The interesting part is since February 24th, right? So since Russia invaded Ukraine, markets are positive. But the global markets, I believe, are up about, call it 6 or 7% since that time period, right? So for the quarter, though, you're looking at global stocks and really just stocks all over the place, right? Whether it be domestic, large, small, or international, developed, or emerging, all kind of down in that 4 to 7% range. The interesting part is kind of down towards the bottom there in the bond market. The bond market has felt pressure from several sides this year. So 2 things. One, Fed's raising interest rates. That's a headwind for bond investors today, right? So if you own a bond, the Fed raising interest rates is likely going to put pressure on the price of that bond because now new debt will be issued with higher interest rates or higher coupon yield. So the bond you own is now theoretically worth less in the market because it is yielding something lower than what the market will now be issuing. So on top of that, though, you're looking at a geopolitical event that has caused markets to flock to safety, which means that corporate bonds, especially emerging market debt, anything that had any sort of risk in the bond space was sold off quite a bit during the Russian invasion. So you have this initial onslaught of just longer duration, high quality bonds getting hit because of the Fed. And then the lower quality, no matter the duration, was hit a little bit because of this flock to safety. It's just been this two-headed monster. We think this is about as pessimistic of a quarter as you're going to get in the bond market, and a lot of it is already priced in. We expect things to ease for the rest of the year, it to be this slow, methodical recovery. It does not mean you need to run from the bond market. And I know Andrew spends a lot of time writing in his blog about why that's the case, and I fully agree with his stance of bonds serve a purpose. And we need to be proactive and do different things to insulate our portfolios from interest rate risk or from inflationary risk. But at the end of the day, bonds serve a purpose in our portfolio. Over time, they will outperform cash. We fully believe that. We fully expect that. They carry more risk than cash does, and they will add value via that route. And they are the best protection against equity market volatility that we can have. So that's what we're looking at from an asset class performance here in the first quarter. Energy prices have been the talk of the town, right? Energy prices have dominated headlines. The reality is before the pandemic, and really once the pandemic settled, what we saw were energy prices, at least oil, sitting in that $60 to $80 a barrel range. That seemed to be kind of the range that things settled in. Obviously, the pandemic was a huge demand shock. So we saw prices drop down around 20 a barrel, extremely low prices because demand just went to the floor. And on the flip side, now we have a supply shock where demand is kind of normalizing. However, supply, because of what Russia has done and what the global economy is going to do to the Russian economy, now we have a little bit of a supply shock. So that we've seen prices rise to, say, 130 a barrel at one point. It has since settled down to 100 a barrel in that range once markets have kind of understood what the impact will be, along with major economies like the U.S. willing to release some of their excess reserves to try to help the global supply. But it's important to understand what higher prices in the energy sector mean beyond just going to the pump, right? At the end of the day, the Fed is making their decisions based upon the data on inflation for the most part. As long as unemployment remains low, and it's very low, and we'll talk about that in a second, and the economy is rather healthy, inflation is the number they're going to look at, right? They are going to look to see how they can get inflation down to a more reasonable 2% figure. Part of it is, there are supply chain issues, right? That's something that they can't necessarily affect. What they can affect is the demand side, right? By raising rates, they can kind of restrict demand to an extent. So what we're seeing is the Fed is likely to potentially be more aggressive, and that's where the market is already pricing that in. Is that, hey, they have kind of been very transparent that they will need to raise rates to fight inflation, and higher energy prices exacerbate that issue. Consumer spending has been pretty strong, right? Consumer sentiment's ebbed and flowed based upon what we're seeing, in markets, right? Geopolitical tensions don't help consumer sentiment by any means, but consumer health, their balance sheets and things like that are very strong. And the good part is that if you look at energy as a percentage of consumer disposable spending, it is as low as it's been in the last, call it 20, 30 years, right? So energy as a percentage of spending of someone's disposable income is as low as it's been, which is good, right? Obviously, naturally, higher energy prices, higher prices at the pump, it does, right? It does affect consumer spending because now more of your income is going towards energy spending. Also, those higher rates then stem through to potentially restrict GDP growth. So higher energy prices, higher rates, all of a sudden we are seeing GDP growth estimates starting to get reduced. When we say trend growth in the US, we're talking about kind of this long-term average trend growth that the US has had, call it 1.8 to 2% GDP growth annualized. What we were expecting coming in this year was 3.5% GDP growth. Maybe some will estimate 4%. That's probably on the higher end. What we're seeing now, though, is that revised downward closer to 2.8 to call it 3% on the high end. So this is stemming through the economy. This is stemming through, the expectations moving forward with higher energy prices. But it's important to understand and keep everything in context that the economic conditions are still strong, GDP growth still above trend, energy prices as a percent of disposable income is as low as it's been in a long time. Keep perspective, understand it will have a ripple effect, right? Especially within the Fed and inflationary environment. But, there are plenty of things that don't make this a doomsday scenario for sure. Going to the consumer, right? Because this is as important as it gets. The consumer is 70% of US GDP growth, right? Consumer spending is very, very important. And there is a lot of reason to be optimistic still for the consumer. There are certainly more concerns, right? Naturally, I think I look at the scenario today as coming into the year, we were very optimistic. Our base case scenario was, markets were going to continue to be very healthy. The Fed would slowly raise rates, and earnings would be still very strong. The consumer very strong, which should all be a tailwind for stocks. At least continue, their growth. Not maybe double-digit growth within the stock market, but still, it was very conducive to equities in this market. What's changed now is that base case is still probably our base case, but the likelihood of some of the more concerning scenarios has certainly picked up, right? Geopolitical risk has now come into really the forefront, and that is certainly a tail risk if something were to escalate beyond what's already happened, unfortunately. But there's a lot to be optimistic about. Economic conditions, you've heard me say it, are still pretty strong. Unemployment is down around 3.6%. January 2020, pre-pandemic, unemployment had gotten down to call it 3.4, 3.5%. That's a very good number. That's by all measures pretty much full employment. The Fed is very pleased with that. We would expect that those numbers are going to continue to improve. We wouldn't be surprised to see 3.5, 3.4, 3.3% unemployment, because if you look at the job openings relative to how many people are looking for work, it is incredible how many more job openings there are than there are available workers. So it's a very interesting dynamic within the labor market. Consumer balance sheets are very strong. What we mean by that is if you look at the average person's net worth, it is as high as it's ever been on average. If you look at bank lending, so the financial health of the market, we always kind of point to 07, 08, 09. You remember that the financial market was the big reason the stress occurred. We don't see things remotely close to that today, right? The financial markets are very healthy. What we can actually look at is bank lending standards. So what you'll notice is banks will tend to tighten before markets start to see stress. What I mean by that is banks will not lend as much. They will start to tighten their lending standards before because they really can see the financial health start to deteriorate. What you're seeing is they're still very willing to lend. Economic and consumer conditions are very strong, which really indicates that we're not seeing any financial stress or anything along those lines in our banking system. So banks are healthy, the consumer is healthy, unemployment is very strong with the labor market. It's just important to understand that GDP growth has been revised downward because of higher energy prices, inflation staying a little bit high, and that the Fed's going to likely have to raise rates. I think this chart's always an interesting one. When you look at this chart since 1980, it's household debt to disposable income. What's interesting is to see how low it's become, right? So, if I look at my debt as a percentage of my disposable income, it's as low as it's ever been, at least in the last 40, 50 years, right? Which is very impressive. And it's a very good scenario for the consumer because that means they're able to spend money on goods, on services, rather than to try to service the debt that they've built up. So all in all, though, the consumer is very healthy. And one of the biggest reasons why we're so optimistic for, at least economic conditions and market conditions, because you're going to hear the R word, the recession word thrown out there quite a bit. Just because you're seeing an inverted yield curve, you're seeing rising rates, there's just geopolitical concerns. There's a lot of things going on, a lot of noise, right? But we have to keep looking through that noise to what the data tells us, what conditions tell us, and that's where we stand from a consumer perspective today. So, kind of wrapping this all up, where do we go from here? First, expect it to be very foggy. There will continue to be quite a bit of volatility. Anybody who tells you what's going to happen in Ukraine, they don't know. No one knows. Most experts would have told you that they would not have expected that to happen. They did not predict that to happen. Some of this stuff it's day by day, hour by hour. The Fed, the path is laid out to what we can expect, but there can always be changes, right? They can always raise rates less. Inflation could always come down. Inflation could stay persistently higher longer. Expect volatility. The fog, though, is going to be driven by the inflation issue and what the Fed ultimately has to do. Will they be as aggressive as they've laid out or have kind of set the expectation for? We would expect that Europe faces just more uncertainty than the US does. I think, when you look at the reliance on Russian exports within the EU, it's especially within Germany, which is really one of probably the staple economy of the EU. There's just naturally concern over where their growth goes if this conflict stays longer and where that path can go. We also believe that the bond market has already priced in most of this pessimism. We still see that yields are probably at the top of where we would expect them to be at the end of the year. So we expect, not too much upward movement from here in that 2.5% range on the 10-year yield, probably the top end. And we do expect economic conditions. You're going to start to see earnings reports come out shortly. We expect Q1 earnings to be good. We expect the rest of the year earnings to be very good, right? And to hit some pretty sizable earnings report numbers. So how are we positioning portfolios? I think it's always important to kind of think as you layer yourself down. Because of our concern in Europe, we're clearly going to remain overweight US over international within our international allocation, which is going to be probably as little as we've ever had here at Diversified. We're going to be leaning towards the emerging markets over developed markets like the EU and Japan. We're going to be heavier in emerging markets. We are going to have a couple of different tactical active leans towards certain industries that we see opportunity, whether it be from a valuation perspective, whether we see it just a supply demand imbalance, one semiconductors, one infrastructure, and also in biotech. We see all three of those as areas of opportunity for different reasons, right? But those three within our equity portfolios are likely going to be staples over the next several months. Within fixed income, we still look at U.S. default rates as very low, very supportive. So we're constructive on lower quality fixed income, which will get us a little bit higher yield. We don't see financial stress that usually would get us concerned about being, or at least having some allocation there. We're also going to own some things that are a little bit shorter duration, like bank loans. Bank loans are floating rate. As bond yields or as rates rise over time, we do like having protection against rising rates via a floating rate position as well. Even though we're going to be shorter duration, our investors should know that we will have a decent amount of just high quality government and corporate debt in our bond portfolio, because at the end of the day, the bond portfolio needs to protect during steep equity market declines, and nothing protects better than high quality U.S. treasuries and even high quality U.S. corporate bonds. So really just to summarize everything, despite 2022 feeling like a volatile period, I think a lot of this had been teed up in November of 2021 when bond yields started to rise. As the Fed changed their position, or at least their belief in what they're going to do, because they now saw that inflation was going to be persistently higher. And then it was exacerbated by the fact that a massive oil exporter was being cut off from most of the developed world. A lot of that ultimately though started in 2021. Markets are pricing in a very aggressive Federal Reserve. Will inflation remain high enough where they come through 7 times this year, or do they actually undershoot that and markets kind of overshot where they thought where they were going to be, and bond yields kind of come back down? We would think that would be the scenario over continued bond yield moving higher at this point. Obviously, energy prices are going to be higher. They have stayed higher. They're going to stay higher until this conflict is resolved, and possibly for a little bit longer as this whole geopolitical dynamic gets figured out. But the Fed has been transparent, and once again, they are willing to be more aggressive because they see how strong the consumer is. They see a very healthy economy from the financial system, from earnings and growth and unemployment. We would just say we expect volatility. You always have to expect volatility when you invest in stocks. It just comes with the territory. We would expect it to remain as typically high, because at the end of the day, there's a lot of uncertainty with regards to the Fed, with regards to what's going to happen from a geopolitical perspective, with globalization, how this all affects globalization. So, we're remaining higher quality. We're trying to be proactive as always, instead of just reactive, and looking for opportunities for, relative value or things that we see the markets have incorrectly priced. So that would be my summary. I know I went through a lot, Andrew, but I wanted to open up for a little bit of questions, Q&A, if any had come through.
Yeah, I have a couple here, Mike. Great content. I mean, like you said, it's been a crazy quarter, a lot going on. Something's always going on. So thank you for educating us. Do you get concerned at all, Mike, about the current conflict will put an end to sort of globalization? And if so, what impacts do you think that does have on portfolios?
Yeah, so for those who don't know, globalization has been honestly one of the big reasons why we've seen such strong stock market returns since, call it the 90s, right? When as corporations have been able to move their labor to, especially in emerging Asia, right? You're able to move to areas like that and get lower cost labor, right? Lower your costs, have higher margins. It also helps reduce the prices of the goods we're paying for, right? You think about what you paid for a high quality TV back in 2000 versus what you can go get for $250 today, right? That kind of world, just the innovation and the ability ability to access other markets, right, and specialize in other markets. The concern is that countries do become more nationalistic, right? That globalization does start to go away. If you think about certain industries, you think about semiconductors, the semiconductor space is dominated by a few companies and a few countries. So that's naturally always a concern. And you can go on and on and on about other industries having the same issue. So naturally the concern when you see concerns over energy, over commodities like agriculture or precious metals like nickel coming out of some of these emerging countries, the natural concern once again is that globalization starts to go down, and what will happen is potentially costs will now go up. And I think really what that drives is a global imbalance of equality, right? What all of a sudden now emerging markets, right? So poor countries don't have the ability to, grow their economies the same way. And I think we would continue to see something along those lines, which would be a concern, when you see, richer countries who can nationalize certain things do relatively well. But, I think it is in most instances better that globalization stays. I think there's always nationally, security concerns and different concerns for why we would want to nationalize certain things. But, that is always the concern about globalization going away.
Okay. How about if US and NATO gets pulled into the Ukraine? What do you expect that'll do to markets?
Yeah, I think it'll rattle markets pretty hard because the uncertainty then picks up, right? I think clearly what's happened over the last, month and a half or month or so has been a clear attempt by NATO to not get involved to the point of it crossing that line. If NATO were to get involved, I think the uncertainty goes from a 9 out of 10 to, a 10 out of 10, because now, you start to talk about, more drastic measures. I don't know if World War III is a great term to use, but I think just uncertainty in general now picks up. And now the entire conversation what the Fed's going to do could potentially change, right? They may now feel that they can't push rates as high because now the uncertainty is so much higher. I think that's, I think NATO will do everything it can to avoid, and as they have, avoid a direct conflict because Ukraine's not part of NATO, and really it's not in their responsibility to necessarily get involved to that extent. But we just don't know where things can go because there are countries like the Baltic states, there are countries like Poland and Hungary who, are knocking, right there on the doorstep of, potential conflict. And, if NATO were to get involved, it's a reason why we would be underweight Europe right now, is because when you start to talk about left tail risk, what could go wrong, right? Not that we would expect that. I think Europe would be hit even harder than anything else, right, given that scenario. So we're just going to remain underweight to that because of that potential scenario.
Great. Okay, well, I guess let's leave it there since we got a couple of good questions in there that were on topic, and we're just about done our time anyways. We'll share this. We'll also have a summary version. There'll be plenty of stuff coming around that you guys can share and reference about the past quarter, what we see ahead, what moves we're looking at. As always, I'm Andrew Rose, President of Diversified. Mike Warwath, the man, the myth, the legend, our investment guru and Chief Investment Officer. Always thankful for your time and expertise and information. It's great. Keep it up. And to everyone that listened today, thank you for being loyal clients and friends. We appreciate it. So, all right, folks, till next quarter. See you guys soon. Bye.
Take care, everybody.